Hello, just checking in. Do we have anyone present with us? Sorry, I was a little bit late. Good day to everyone. Our goal today is to check why or to understand why I think we're due for a major correction over the next couple of days at best, couple of months at best. Sorry. Um, yeah. So, first up, what I'd also mentioned in my video is the volatility that we're seeing in gold and silver. So if you look at gold's chart, I use TradingView. The idea is quite simple. They don't charge us just for looking at a few charts. Investing.com and the rest do charge a lot, and tracking on MCX is not the best because usually the fluctuations in price in INR, which is Indian currency, and MCX tracks only Indian currency. So the fluctuations in INR are usually different from the fluctuations in the dollar, whereas dollar is the accepted currency. So I would want to track gold's movement in dollar and not INR. That removes one layer of volatility that shouldn't matter to the larger economy. So that's why I would use TradingView or investing.com or whatever else that tracks independently. Now, if you look at the volatility here, and the way I found it was by checking through ChatGPT or Gemini, to be honest. The amount of volatility we saw recently in gold, this massive fall, about a 20% fall in gold within, like, say, a week, that has only happened from what I have managed to see twice. Once was in the 2007-8 crisis, right before the major bust up, and the other was 1979, I think. Those are the only two times that we saw such a major crash in gold and then a recovery. The same applies to silver. So that's what tells me that right now may be the reason why it is happening. But a bigger reason is if you look at the US GDP growth, and I'm here tracking the US because, of course, most of the funds are growing into the US. So now if I track US ka GDP growth, so you see quarter on quarter, we see about a 3.8% or a 4% growth. But the bigger issue here is that this growth is not coming from, let's say, consumption or exports, right? This growth is mainly coming from three big regions. Now, first, what they call consumption is only consumption by the elite. So there is a chart, and I'll link the video in the comments after this. But there is a chart that clearly shows कि US के अंदर जो the elite consumption has grown by, let's say, 45%, whereas the consumption of middle class or the lower middle class has grown next to nothing. So most of the consumption is coming from people who are actually invested in the stock market and gaining wealth from the stock market, let's say, right? Those are your close to billionaires or millionaires or multimillionaires. So the consumption part goes there. The second reason why you've seen this growth in the US is exports. Now, many argue, so if I show you US exports ka chart, US exports have grown by a decent amount, right? So even if you don't use this, US exports have grown by a decent amount. But that has not happened because they have suddenly started making something new. The reason that has happened is gold that Norway or England or India had stored in the US has started flowing out of the US. And because gold is overvalued, it seems like we have exports increasing. Whereas it's not the exports that's increasing. And that is what we are seeing in the US GDP growth. So the first factor was consumption, which is being driven by the elite, not by the majority of the population. The second factor is the export growth that we've seen in the US, and that is driven by gold being exported. You must have heard of this. Major countries, right? UK, Norway, India, Germany, everyone's pulling gold out of the US because they don't trust the US economy. So big part of this 3.8 or 4.4 is coming from these two elements. Now, the little bit of consumption that is still coming from the US has come in because the president there, Mr. Trump, decided to remove healthcare for all, which means now people have to pay insurance premiums. And a large part of that expenditure, the personal expenditure that we've seen keep the US economy afloat, has come from this expenditure going into the insurance or healthcare. People are paying more for medicines, people are paying more for doctors. That's where it's coming from. In fact, there's a paper on this out. I'm not sure if it was by Reuters, but a simple Google search will get you this paper. And that talks about how the people in the US are now poorer, sicker, fatter, iller. And that's what's driving the consumption. Add to that, if you check the US unemployment chart, which everyone sort of says is what dictates where the economy goes, right? If the unemployment rate is rising very high, then people naturally anticipate a recession, which is, well, understandable. This unemployment chart hasn't given us a true report for some 6 months now. Since the government shut down and since Mr. Trump removed the person, it's called the US Bureau of Labor and Statistics, he removed the chief of this department in order to, or his claim was that she was fudging facts. Whereas what has happened is ever since she's been removed, we haven't gotten a true piece of data. So we don't really know if this unemployment rate is 4.5% or if it has already reached the 10%, 12% that leads to recessions. So another thing that is artificially propping up the US economy. But then the natural question becomes, why would it crash now? What has suddenly changed? Just a second, I'm reading through your comments. I'll just get to this in 1 minute, Aryan and Ramit. I just want to make sure everyone understands exactly what we're dealing with here, and then I'll take all questions. Give me 5 more minutes here. So we've already talked about where there is a natural weakness. There's a deep weakness in the US economy. We already know that Indian economy is also suffering. I'll get to that as well. But finishing off the global economy first, US economy is weak. But why would it fall right now? That's all right, Chirag. What we've discussed so far is how the US economy is inherently weak, and you can watch it back later to see all the details. Now, why would the crash come now, right? One of the main triggers or one of the main leading indicators of that is the gold ka volatility. The more volatile gold is, the more likely it is that something big is brewing, because gold gives you such big movements only when people have to sell, just have to sell to cover margin. Otherwise, itna bada movement cannot come because a retail investor is buying some extra gold. This can only happen when you have behemoths making moves and forced moves. Nobody wants to sell at a 20% discount. Now, why, with all of this, do I say it should happen now? Not just gold, not just a leading indicator. Fundamentally, the problem is the AI revolution that we've been dealing with. What has happened is a lot of investment has flowed in, and that also brings us back to the GDP growth. All that investment that has gone into AI has played a major role in propping this up. In truth, the total investment that has gone into the US economy has actually fallen last quarter by about 0.2%. Whereas overall, if you bring in the AI investment, just the AI investment, you will see a 40% growth. This year, they're going to again double their investment about, right? They've committed $650 billion this year already, and we're already only in Feb. So all this AI investment that came in kept the US economy going to some extent. But now we've reached a point where everyone is saying, yes, there's investment, but where is the revenue? So for an year and a half, patience, right? But now that we also have this new Fed chief coming in, who says that I'm taking liquidity out of the system. He's been saying that for his entire career. Now investors are questioning, we need revenue. Because if it's just investment, then this Federal Reserve will not work. This Federal Reserve is not going to let the companies survive. The second factor that is affecting this downfall of AI, and the reason I say expect it very soon, is because the quote unquote IPO of OpenAI, which has been anticipated for so long, is just not coming out. And the reason behind that, as most experts would now, well, at least say under controlled breath, would be that OpenAI cannot disclose its books. It's simply not making enough revenue to justify the valuations at which it is taking money from your Nvidias and your Googles and everyone else. So all of this is finally now coming to a head. What happens now? Where does the money come from if investors are not ready to put in more, because the Federal Reserve governor that's coming in is going to tighten up liquidity? And the final nail in the coffin is the inflation factor. So when the US went into the large tariffs that they declared, everyone thought we'd have a temporary surge of inflation and then everything will stabilize. That inflation never came. And everyone was wondering why. Most people were saying that, you know what, Trump probably did a good job and that's why we didn't have inflation. But what really happened, and this is visible in the US growth charts as well, US consumption charts as well, right? How companies are using up or investing in their own companies. So, for example, let's say I was someone who bought clothes, textile from India, and then sold it to US citizens, right? Now, if I buy clothes for, let's say, $100,000, then the moment I buy it, that investment is counted, right? When I sell it, then investment will not be counted again, right? It'll only be counted once when I bought it. So if I bought $100,000 worth, that's invested. And that's what most companies did about 3 quarters back, April, May, June, when the tariffs were about to come in. They stocked up everything. So that showed up as investment in the economy. So the US economy here again seems to be growing very fast. But then now that they are done, now that they've sold all that stock, everything that is bought now is going to be at a higher price. And all that price will have to be paid by the consumer. As we know, there's a 96% flow through. If 100 rupees of tariff is to be charged, 96 comes from the consumer, which means that's inflation coming in. And if inflation comes in, what does the Federal Reserve have to do? It has to hike, not forget about cutting, it has to hike. And that's what you saw with the RBI policy as well. If you saw how our governor was, he made it very clear that there are no more rate cuts coming. And I also expect that there probably will end up being some hikes. The reason behind that twofold. One is this whole tariff thing that's happening. It's finally going to show up in the economy. The second is our oil, which is now going to get significantly more expensive. If you're not buying from Russia, as we've already claimed with Mr. Trump, and we're buying from Venezuela or the US, then our pricing goes up by some $30. That is immense, right? That's about a one-third jump in price. Who's going to pay for that? We will have to pay for that. Our OMCs will pay for that. Now, even if we forget about the inflation impact on us, if our OMCs have to pay, that is thousands of crores of dividend gone. If I'm not wrong, the OMCs paid some 9,000, 10,000 crores of dividend to the government every year. So that's going out of the budget as well, which is why you saw in the budget, Mrs. Sitaraman had to reduce the total expenditure. She might have claimed 12.2 lakh crores, but we haven't really seen where is that 12.2 lakh going. In very tangible elements like defense, for example, we didn't see a massive increase, right? We saw increase less than what we thought. This is all that's all. Yeah, I hope you guys can hear me again. I'm sorry about that. That was just I know, sorry about that. Okay, so all that we've discussed so far, right? Just to put it in context again, we know the US economy is fundamentally weak. We know the triggers that are coming in now are driven by liquidity because of Federal Reserve suffering. We know that the new Federal Reserve governor that's coming in is going to drag the liquidity out. We know investors now need these companies to show real real growth. So this is the US GDP chart that I was talking about, right? This growth, this is the third thing we discussed, right? Most of this growth is coming from artificial manipulations, right? Because health insurance has become more expensive, medicines have become more expensive, AI has just been pumping money into the system, in that too in a circular fashion. That's where this is coming from. Most likely we're going to see this just disappear. Like there's going to come one day where everyone says there's no revenue. It could be OpenAI's IPO. It could be one bad result from Nvidia. It could be another anthropic moment where we suddenly realize that we don't need half the IT firms in the world, which is again going to take time, but going to happen. So what we've talked about so far is how all of this is finally coming to a head. And the reason that it has to happen right now is because we're now going to get an inflation surge. This inflation surge, driven by the fact that whatever the companies had stocked up in anticipation of Trump tariffs, has now been sold off. So now everything that is brought into the US economy is going to be more expensive, significantly more expensive. We're talking about 18%, 25%, 50% tariffs. So that's a massive price jump. That means central banks have to hike rates. And if that was not enough, if you see the prices of metals, they're close to where they were when we were at the worst in inflation. When our inflation, so for example, if I show you an aluminum chart, and this was my breakthrough moment, right? When I saw the metals chart, that's when I knew that inflation is making a comeback. So if you remember, this is where the Federal Reserve, about 18th October, I think, is when Federal Reserve had first hiked. This is when that had happened, right? Then aluminum was about 3,185. It's about the same level right now. So in the background, we already have that inflation. We can see that in metals. Aluminium is a very important metal for the economy, right? We can also look at copper, for example. So even if you look at the copper chart again, here in 2022, you can see it was at 4.75 about. It's at 6 about right now. So all the metals that are important for the economy are again in a very inflationary environment. That means the central banks cannot cut rates. They are stuck. And at the same time, the economy is going to need rate cuts. It's going to need liquidity. But then we also have a Federal Reserve chair coming in May who says, I'm not going to increase liquidity. I believe that the Federal Reserve balance sheets should not exist. He's not just saying he's going to reduce it a little, he's saying he's going to reduce it massively. You combine all that, and the next trigger, whatever it is, whether it is one of the AI companies suffering, whether it is Iran and US doing something well unthought of, or if it's the Hormuz Strait closing down, any of these can no longer be controlled by the central banks. And that's why the next trigger will be big enough to sink major economies. That's why it didn't happen so far, because there were always central banks, there were always governments coming in. Now they can't. Our RBI governor said that. The Central Bank of the US said that. The Bank of England's chair also came in and said the same thing, that they just do not see this space to cut anymore. So that's my thesis around why I see this happening. For those who believe in technical indicators, you see the gold and silver volatility. Only maybe silver we can leave out because it is a cheaper metal, so you can have some trading in it. But gold volatility at this level only happens when whales have to move massive amounts of money. Yeah. Okay, now I'll just look at some questions, and feel free to send in more questions. It kind of pushes the conversation forward. So starting with Ramit's, the Indian market might fall further, gold price surge and other things. So I don't think the gold price surge will cause the fall, Ramit. The gold price surge is an indicator. When gold rises heavily, that means people are moving to safe assets, right? Like right now, I have half a mind to buy a lot of gold because I don't know if the financial system is going to collapse. But is the Indian market going to crash? Yeah. I'm not just saying that it's going to crash because the US economy is going to suffer. I think it's going to crash for our own reasons. Like if you look at, for example, Bajaj Finance results, right? One of the biggest NBFCs in our country, not one of the biggest NBFC in our country, right? Their results showed significantly higher provisions. In fact, barring SBI, every bank has also shown significantly higher provisions. Now, banks already see that something is going wrong. You look at gold loan companies like Muthoot Finance, and I think they're running at a 10% default rate away. 10% credit cards at 10% defaulting rate, meaning 10% of the people haven't paid their bills for 3 months in a row. You can look this up, right? It's right there on Google from very trusted sources. So in the background, our economy is very weak. And if you think about what growth have we really brought in, yes, we had brilliant growth in 21-22, but since then we have massively slowed down. Most of the government capex, I'm not blaming the government here, to be honest, it's the private sector's fault. The government gave us a couple of years, 3 years of massive capex, right? Our 2020, 21, 22 budget, even 23 to some extent, were massive budgets. The private sector should have started their capex earlier, but they did not. The biggest capex you'll see right now would be coming from the likes of IOC and BPCL. They are the ones who are saying we're going to reinvent this. NTPC, they are the ones who are doing this capex in the private sector and whatnot. So yes, will the Indian market fall? I think we will have to fall. If you ask me for a number, it's very difficult to put that because panic selling, anything can happen. But for me, a range where I would say that I'll most likely be 100% invested would be the 20,000 range. It's what I'll be 100% invested. It might not come that far, might stop at 21, 22, but I'm looking at that at least. If not just for the global factors, for the Indian factors as well. Very honestly, Ramit, I'm 100% cash right now, like maybe 5% invested, and I'm massively short. I've been short since I think September 2024, and I slowly built up my position till Jan. Then we had the massive crash because of the Trump tariffs. That time I lightened up a little bit, then I added shorts again. If you talk about what sectors I'm short on, heavily short on metals right now, but don't follow me. I'm not a registered advisor. I do well in the markets because I've been saying this for 30 years now, since I was a baby. So some things just make sense. For example, metals being this overvalued does not make sense, right? For aluminum to be trading at 3,000 while we're talking about a global slowdown, that does not add up to me. So I am massively short on metals. I think Nalco is my biggest short position, and Hindustan Zinc is the second position, mainly because of silver. I'm also short on gold loan companies, have been for a while. Muthoot Finance is where my short is. And the very simple logic behind Muthoot Finance's short, I'll show you where it made sense, just in case you want to try to see how this can be done later for some other companies. It's not just about the price chart, right? So I look at the price chart. I hope you can see the screen. Yeah. So if you look at the price chart, this massive move, right? It can't sustain. You can never sustain such a massive move. The only way this happens is if the earnings grow a lot, and the earnings did grow a lot, right? Muthoot Finance saw some brilliant earnings coming in, but even at the peak of their earnings, they're trading at an expensive valuation. Not just expensive, about what, 14 to 21. That's a 50% premium. Now, you usually pay a premium on earnings when you expect the earnings to increase in the future. Here, the earnings have already massively increased. Gold is not going to go to $10,000 an ounce, right? Even if it does, how many people will have gold to loan out, and how much default will Muthoot Finance see? If gold reaches $10,000 an ounce, that means the global economy has basically come to a standstill. It's a safe haven asset, right? It doesn't have industrial utility. It will only rise that much when all the central banks are not selling and every big investor is buying gold because nothing else is working. That means people are defaulting. So Muthoot Finance results can't be good then either. So this is peak. It can't do any better than this, and it's still trading at a premium. Then I went and I said, okay, fine. Maybe the stock will go higher. Maybe it'll go to 4,500. Maybe it'll go to 5,000. I'll keep shorting every 10% up. I'll keep that room. I'm okay to take a loss. It has to come back down to earth. There is no mathematical way for it to keep increasing its earnings this fast. It can increase its centers slowly, and then it can increase earnings 10%, 8% a year. But to trade at a 21 ka valuation, it has to increase its earning by 25% a year. वो नहीं होने वाला. That was my logic behind Muthoot Finance ka short. Now, I'm also short on public sector banks, specifically PNB. That is not something that I'm incredibly confident about because the government can anytime come in and suddenly say that they're privatizing. So that might have been a mistake. And hey, I make mistakes as well. But yeah, I am holding that short. Maybe Chirag, maybe it'll be the US government that triggers the collapse. But what I do know is that I don't see how this goes on for more than a month or two. It's not just the valuations in mid cap and small cap. And this is something that I really want you guys to understand, right? Nifty, the way the valuations for Nifty have been calculated has changed recently, right? I think 2020 may that changed. So when you look at Nifty ka valuation right now and you see that it's 2022, before this period, right? Before this region, 2020, all this calculation was not done the way it has been done right now. All this calculation was done earlier on a standalone basis. Standalone meaning, let's say we're talking about Reliance, right? So the earnings of only Reliance Incorporated were calculated to calculate Nifty ka earnings. But Reliance has 10 subsidiaries, right? It has Geo, it has your Milk Basket, it has so many other entities that make Reliance money. They weren't added. After 2020, they have been added. So when you see this earnings, this is consolidated. If you remove the consolidated earnings, you have to give this a 20% premium, which means we are not at 22. We are actually at 26, 27, somewhere here. We're at this region, somewhere here, which was the peak before 2019, which is one of the highest PEs ever. 08 में भी उसी के आसपास थे. So this PE is a blatant lie. That's not how PE was calculated earlier. So NBFCs is another sector that I'm short on. I think it's my second largest position. I'm short on Bajaj Finance and I'm short on L&T Finance as of right now. I'm looking for an opportunity to go into Shriram Finance as well. So let's say Bajaj Finance, right? Why am I shorting Bajaj Finance? A very obvious question. I'm shorting it because credit issues. I think India is going to go into a mild NPA crisis, which will affect NBFCs more than it will affect private banks. Because the likes of your HDFC, ICICI, and Axis Bank, right, they don't lend out to people who might be a little weak on repayment. They usually lend out to people who are either affiliated with a corporate or they've got good enough guarantees in the background. NBFCs lend out to people with weaker credit, generally, very generally. So if a credit crisis is to come to India, even a mild one, then they will be affected. Your Bajaj finances and your L&T finances will be affected worse. So yes, I'm short on... just a second, I'm opening it. There we go. So I'm short on L&T Finance and Bajaj Finance as of right now because they've risen up a little too much. L&T though I picked up it right at the peak about, I think. I picked up it around somewhere around 300 or so. Bajaj Finance, again, at current price is about. Again, but don't take this to be like an investment advice, right? Please do your own research. I'm just sharing my opinion. I think, Ramit, both US and I'll come into Aadhaar Housing Finance in just 1 second. Ashima, sorry, I read that one first. So I think the US market has to collapse for this to end. If the Indian market alone collapses, then this isn't over. Then we have to wait for another collapse, Ramit. So I expect every market to do poorly, especially Indian markets. When there are cracks that have been covered, there are some massive cracks that have been covered, and the moment any major turmoil comes in, those will be revealed. Now, about Aadhaar housing finance, to be honest, I don't follow it very closely. I've been out of housing finance and even NBFCs for a good, 1.5 years now. Since September, I haven't looked at any home finance companies. And if I'm being very honest, for me, in within housing finance companies, I think one of the better ones is Home First Finance, just from a product point of view. I'm not gone in depth into these, so I can't give you like a real opinion on this. I can give you a very cursory opinion. I don't see a problem, I suppose, with the company. It's trading at a decent valuation. The investor holding looks good. Promoters have reduced, but they have to bring it to 75, so this is not bad at all. FIs have increased, DIs have increased, the number of investors is coming down, so accumulation signs are everywhere. You've got some good funds invested. So at a very, again, cursory glance, right? I haven't seen this well enough. At a cursory glance, looks brilliant. You've got amazing profit growth. There's no doubt about it, right? You've got at least a 10-12% revenue growth in this environment. The credit growth isn't great in India. So Aadhaar Finance, housing finance looks good. Manappuram Supreet, I wouldn't go into. Now, of course, the whole, I think, Bain Capital or whatever can play out. That's very different. But as a business, gold finance companies, I would be miles away from. Personally, I'd be miles away from, especially at 60p. That though is insane, right? Like even now, if they haven't increased their earnings, up to when will they earn money, right? Though I think there must have been cleanup. Possible Bain would have gone. Whenever private equity comes in, they go through some significant cleanup. That might be one reason for the lower profits right now. I wouldn't judge it just on profits, but because gold has to either go sideways or down now, I don't see how I can go into gold finance companies. If you want, I can show you gold price ka chart to just sort of drive the point home of why gold has to consolidate. Because this hasn't happened for the first time. Right? This massive has happened multiple times. You see, we can see those three peaks right here. 79, massive crash. Gold, 780, right? Excuse me. And then when did it come back to 700? In '08, in the next crash. That is 28 years, zero return. Then again here, 1825 ka peak, it came back here in 23, 12 years, no return. And this is in a low interest rate environment, right? This should be brilliant for gold. Even then it took 12 years. So whenever gold starts consolidating now, this is going to be a 10-year downturn. Every major investor is going to pull out of gold loan companies or whatever else, mining companies. So no, I wouldn't go into Manappuram Finance. That is brilliant. Sorry, I'll just come back to Ramit. Chirag, right? Even though FI is leaving, our DI is increasing massively. That's what he wants. Right, Chirag. So I talked about this point with there's this guy from Kotak. I have an account with Kotak as well, and we have these discussions once every 2 or 3 months. And he said the same thing, that DIs have this much cash and then they have this much SIP flowing in. But think about the last big recession, right? I'm not talking about COVID. COVID was not really a recession. Yes, people lost jobs, but the government paid you, right? Government gave you food. You didn't have to pay your loans. You didn't have to pay your rent. If, well, a landlord could not push you out, right? So during COVID, people did not suffer. Companies did. And then the government came in and bailed out everyone very quickly. COVID doesn't count. You think about '08, '09, the number of people who lost their jobs, the number of people who could not sustain their lifestyle without breaking their FDs and post office deposits and mutual fund investments was very high. You have 10 to 15% unemployment rate. Now, these are going to be the people who have to now sell their mutual funds just to pay the next month's rent. You know that in our generation, there's a very small chunk of people who own their houses. If you take out people who have taken loans, right? I'm talking about outright owning. Even if you have a loan, you need regular income. What happens when there's a recession? You don't have regular income. What do you need to do then? You need to break your investments. What are you going to break? You're not going to sell your gold. You're going to sell your mutual funds, right? Gold has too much of an emotion attached to it. So that is why even though DIIs do have shown immense strength, that might turn out to be India's biggest weakness, because the day that breaks, where do DIIs go? they're keeping what, 4% cash, if I'm not wrong, 2.5 to 4% cash rakhte hain. If they have a total AUM of 100, they're only keeping 2.5 as cash. The wise way is to keep 5% as cash. That is what, if you talk to any economist, if you talk to someone who makes policy, they'll tell you that you should at least have 5% cash when you're investing for someone. Because if a bunch of people want to pull out, 5% is where you'll probably be safe enough for at least a day or two, and then you can figure something out. Our mutual funds are keeping less than that, 2.5, 3%, which means now if we run into trouble, then our mutual funds run into deeper trouble. So that isn't something that will help us in a deep crisis. In a small crisis, yeah. Big crisis, that becomes a bigger weakness, in fact. Now, dollar is brilliant, Ramit. So right now, I think dollar is weak, and Trump is trying to weaken it further to make exports more likely for the US to win out on, price competitive. But I don't see how the dollar keeps losing its value. Now, we can make a quick check. This isn't something that I've looked at very deeply. But let's say if you look at the dollar index, not the dollar, for your case, let's look at the USDI now. Let's say if you look at this chart, and let's think about the last crisis, right? You can see live, right, how I think about these things. So during the crisis, right, before the crisis, the dollar fell, and pre-crisis, it kind of sustained, right, through this entire 7-year period. When the market started to recover is when dollar had fallen a little bit, and this is a massive crisis, right? This is when, well, the US economy was basically looking like it's going to shut down. It nearly shut down. And even then, I think the collapse was what, some 10%. So I don't think dollar will fall too much. It is the world's reserve currency, and the US is not going to change that. Now, the way I'd hedge this bet though is I'd go into Bitcoin a little bit. I'd go into cryptocurrencies a little bit. I have already, like for my son at least, I've already invested a certain amount that in case cryptocurrencies become really big, will just pay off for him. But if I want to hedge my dollar bet, I would hedge it using cryptocurrency, because the second is not going to be, or the second currency, reserve currency, is going to be either gold or crypto. Gold is already too high. Crypto is at a good point. So small though, right? Crypto is very expensive. Crypto is very risky, sorry. So that isn't something I take big exposure on. But again, make your own decision, right? Like, don't just follow this blindly. Think about it. Crypto can actually hedge your dollar very well. And that's a brilliant decision to go into the dollar. Any take on crude prices? It has to rise. It absolutely has to rise. Electric vehicles have not delivered on their potential. I, for example, like the feeling of driving an electric car, but I test drove a couple of electric cars here, and then I test drove like an ICE engine, and I was like, you know what, I would like to go for the ICE engine instead. Not just because it feels like nostalgic, more because practically an ICE engine is easier, right? Even if you think about, let's say I want to drive from here to Coorg, right, which is what, a 4 or 5 hour drive for me. I'm constantly worried. Yeah, I have 2 or 3 stations in the middle, but what if they're not functioning? What if something is wrong? What if there's no electricity? That's infrastructure has just not been built. Not just here, right? There are very few countries where it has, and even where it has been built, like your US, you see that people are not really buying electric cars at all. Tesla's performance in India, or electric vehicles generally. I think recently Stellantis pulled out of its EV move. Stellantis had invested some 25 billion or something already into going electric, and it's pulled out of it, saying that the industry just has not shown enough potential for them to go into it. They decided to take the loss, 25 billion straight cut off. And that's one thing. Second is, more importantly, to be honest, we need metals now. We need a lot of metal just for the AI boom. And even if we go into a crash, AI is not going anywhere, right? It's going to be the next big thing, most likely, unless everything has been a farce. Data centers, AI, the infrastructure will need to be built, especially in power. We do not have enough fuel in the world to build that. Forget about the power we'll need to run the thermonuclear plants, the thermal plants, right? Even if we go nuclear, just the infrastructure that needs to be built. Behind that, every column, every barrel of cement, there's oil. So oil has to go up. It's been subsided by China not growing as fast, or the whole green push, and people have been discounting that, but I think it has to rise. Especially US Iran is a major risk factor. So would I go long crude? No. This is not a risk I'm willing to take, because it can give me a 5% move up and down, and the lots for crude are humongous. So I wouldn't risk my portfolio. But if I was like a 5,000 crore person, I would then probably even go long crude with a 6-month to 12-month horizon. Now, Supreet, this is very interesting, right? So everyone is suggesting that this whole AI thing is going to eat the Indian IT sector. Now, and I, to be honest, do not have real data to back this up, but I now feel like this is might be a good time to start entering Indian IT. Not every company. I'm in fact talking about the most boring companies. I'm talking about the likes of your TCSs. I'm talking about the Infosys of the world who are not doing anything brilliant with AI, who are just doing the basic work, right? Which is BPOs, or working on just maintaining softwares that already exist. I'm talking about those companies, and I see them making a strong comeback because I simply believe that AI has not done what everyone is starting to believe it will do. Because if you look at, for example, in the US, they conducted a survey and they asked all the companies who are already using AI if AI has increased their productivity. Only 12% said that there was any change in productivity. And the US ka overall productivity is still where it was in 2019. Whereas that's the country that has taken on most of AI, right? Every good software. But there hasn't been any change in productivity. If there hasn't, then why would the bigger firms, now I'm talking about the firms that give Infosys and TCS contracts that matter. I'm talking about the likes of your HULs, I'm talking about your oil firms, Shell, BP, right? Why would they move to an AI based firm where there is no accountability, right? Because if an AI software could just go wrong, it hasn't had enough time to train. But when there's humans involved, there is a chain of command, there is natural hedges against mistakes, massive mistakes. I don't see those companies moving as fast as everyone seems to believe. And that's where I think the large cap Indian IT would win out. I would be very careful of your Coforges and persistent systems, emphasis on the lot. I'd be very careful of those companies because they have also built themselves on the idea of being an AI driven company, right? Like they are working on machine learning and AI and whatnot. So they'll probably be hurt the most. Even Indian IT might suffer in the crash. But from an accumulation standpoint, I don't think an emphasis is going to disappear, right? So that's where I think I might go into this. Will this have any impact on real estate? So this is something I'm very proud of, Chirag. I called out a slowdown in real estate in the US in 2022, I think, and then I said here that the price of flats and everything in Bangalore, in a place like Whitefield, is higher than the price of a flat on the outskirts of London. That just does not make any sense to me. Like you can buy a house in London for the amount you buy a flat in Bangalore. So do the prices have to come down? Let's forget the whole the absurdity of the prices in India. Even if we focus on just the demand and supply, right? You will notice that I think the home sales were down 28% last year in India, nationwide. So if that is happening, then flat prices will for flat or land. Let's leave land out, right? Let's just stick to pure residential place, right? Your apartments, your villas, right? They have for now, I think, stopped growing. And generally in real estate, prices don't fall. Even if they do, in extreme liquidity issues, they might find fall 10-20%, barring like a GFC. So will the prices fall a lot? I don't think so, but they might stay at the same point for a long time. And eventually central banks will have to cut rates. So if the question you've asked is because you're planning to buy a home, I probably would not take a loan to buy a home right now. If it's about just buying it outright, yeah, sure, go ahead. If you're buying it to live in, why not? Otherwise, of course, I always prefer land over an apartment. But if you're taking a loan, I would wait for lower interest rates. Let the central banks get forced into lowering interest rates. They'll have to pump liquidity out most likely, which means your money will buy you more. In that case, real estate can become cheaper. So let's say US reduces its balance sheet by $2 trillion, right? Then that means you've just taken out a massive chunk of liquidity from the world. If the liquidity goes away, prices have to fall because your money will be worth more. Just as it had fallen in value because central banks increased liquidity, if liquidity is reduced, your money will also be worth more. That's deflationary in a way, but that doesn't show in small transactions. That will show in bigger transactions like homes or whatnot. I love Amy Organics, like Acutas, right? I keep calling it Amy. I love the company from a long-term point of view. Would I buy into it right now? No. So, for example, I've been waiting to buy Ether Industries. I've been waiting to buy Amy Organics. There are many other companies that I'm just waiting for it to come to the right price and to enter. But long-term, a brilliant company, not just for the EV play that it has come in with, but in general, yeah, great company. You know. Now, H&R is investing in small caps. Wait, so I spoke to a couple of H&Rs. I haven't seen too many people go into small caps. Now, if a small cap is corrected by 40%, of course I would invest in it. I'm investing in some companies, very small companies, like I went into Delta Corp. I don't see how a company that has more reserves than it has market cap doesn't make a good investment. So I went into that. So if you see HNIs going into small caps, it'll be very selective. And then, yes, it'll be a 5 to 10 year view, because then it's going to give you good returns, right? It's going to give you a 15-20% CAGR. And that's all that you care about from a cash investment. Corporate bonds depends on the company, but in general, they're very safe. If you're going into a bond issued by L&T, right, it doesn't get any safer than that. The company's not going to go anywhere. The government will save it. The government has so much money invested in it. So very safe. But no, don't go for bonds that are giving you like a 10% or 11% returns, right? The greater your yield is, the worse the bond is. So if you're going into a bond, like the idea is my money needs to be safe. I need to protect myself against inflation. That's all it is. So that means if you get a 6 to 7%, 8% yield, that's good enough. That's all you need. Any other questions? You haven't asked any questions about the crash. Anything else? All right then. I'm going to be here for another couple of minutes. I'll just switch off the camera and mic, but I'll be here in a couple of minutes. If you have any questions, still, if in case you're typing or whatnot. Otherwise, thank you for joining me, everyone. This was amazing, as always. If you have any questions even afterwards, if you watch this in the background, just drop it, right? I'll get to it. Thank you. Kedia Securities. So Advait is again a very good company. Give me a second. I'll show you that. If you're someone who likes to take risk, because it is a high risk play, but Advait is a very good company. You're talking about the transitions? There are two, right? Where's the second one? Oh, okay, so renamed. I haven't seen this in a few weeks now. But long term, I think this is a brilliant company. If I'm not wrong, they're looking at building nearly a 1 gigawatt or a 2 gigawatt capacity over the next 5 years. If they manage to do that, then their market cap must be significantly higher than this. So yeah, long term, this can be a really good company. It shows now it's 6% up, especially 8% up, especially because the government has kept your general capex, which is public infrastructure capex, pretty high. Other can still do pretty well. Supreet, see, it's very difficult to tell you exactly how brutal it will be, but it will be brutal. Like, there are two ways that I see it can go, right? One is that it's prolonged, meaning it just tests your patience for years. It's already tested people for 1.5 years now. That way, it stays on for 4 to 5 years. But before that, there's going to be a liquidity reset, right? That liquidity reset would be a massive crash. It could be anywhere from a 30% from the top to as far as 60-70% from the top. I can't call that. I'm not good enough to call that. I don't have enough experience to call that. But it will be brutal. When I say brutal, I mean till the time you don't see talented people out of a job, know that the economy hasn't really reset. It's a very sad thing, but I know that there are people around me who I love and care for, who are extremely talented, and I know that they're going to be the biggest losers of whatever happens. I always like to wait from it. If I know that the market is going to crash, I wouldn't invest. I always like to wait. But if you're a long-term investor, then every great analyst will tell you that long-term investors shouldn't wait too much. SIP would then be the best way to do it. But I am waiting. Personally, I am not buying into anything away. All right, ciao. Thank you very much, everyone. I'll be back next Sunday and maybe even before that. Let's see. We'll put up a post. If you guys are available, we'll find another time midweek. But brilliant. Thank you so much for your time. And I hope that you guys make better returns than I do. Cheers. Thank you.